Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast, where our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. Now, our guest for this week's show is industrial real estate expert and founder and chairman of Westmount Realty Capital, Cliff Booth. Now, for over 30 years, Westmount has employed an industry-leading approach to commercial real estate investment that has consistently created value through multiple market cycles. They inspire new and creative value. They inspire new and innovative strategies for commercial real estate investment and development. Westmount is a private commercial real estate investment firm that specializes in value-add industrial, multifamily, and office space. With offices in Dallas, Chicago, Atlanta, Milwaukee, San Francisco, and Orlando, Westmount has done deals in markets across with strong growing economies across the U.S., including Houston, in addition to cities in the Midwest, Southwest, Southeast, and Western U.S. The company also has investors from across the globe that have been with them for more than 20 years. Now, among his many notable achievements, Cliff was one of the first to assemble a significant portfolio of flex industrial properties in the United States, and also a pioneer investor of office and flex industrial in and around downtown Dallas in the 1990s. Now, to date, Cliff has led the company to build a portfolio of over 15 million square feet of industrial properties and 4,000 multifamily units with office in several cities. And so, guys, with that, it's my honor to welcome my guest for today's show, Cliff Booth. Cliff, how you doing today?
I'm doing great. Appreciate the opportunity to be here.
Yeah, I appreciate you joining us here and taking the time out of your busy day. First and foremost, Cliff, I gave the introduction there, the brief bio. Obviously, there's probably lots of voids in that, and so I'm going to pass it back to you if you would, and take a few minutes for those folks that aren't familiar with you and your group. Tell us a little bit more about yourself, the company, but also maybe even you, how you found your way into this real estate world some 2 or 3 decades ago.
You bet. So I'm originally from Montreal, Canada, have lived in the U.S. for over 40 years. And as you said, we're a Dallas-based company, been in business for over 35 years. We're a private company, and we're national in scope. We're very hands-on. We're what we call in the business a prototypical operator. So we're not an aggregator of capital. We're the group that sources and underwrites and finds opportunities, and then we manage through them and do construction, all of that internally. And that probably differentiates us a little bit from some of our peer group. We like to think that's part of our value add strategy, that we have an in-house engineering and construction management team that vets and looks at the property before we buy them. We like to say that they have to eat what they cook. So they find whatever problems are with the properties, and they actually have to then unfold and fix those properties. And so we rely on them a lot. These are great folks who've been with us for a long time. And we're able to then bid competitively and know that when we buy something that we know what we're getting, and that we've conservatively addressed whatever issues have to be fixed on the properties, and that's a big plus for us. But as you said, we've been doing this for a long time, and we try and be careful, and we've never gone for growth for the sake of growth. We just like to do good deals, and as I like to say, not do anything stupid. So, it's been good the last few years, and now it's a little bit of a choppy time that we're entering into, and I think it's a time one has to be careful.
Yeah, no, I agree with that, and I definitely want to expand upon that point, but I'm going to hold that for a few minutes here. If you would, you yourself, Cliff, how did you find your way into this world? Was it shortly thereafter college, or when did you stumble into the commercial real estate space?
So my family in Montreal was in the antique and art business, and as a second business, they were in the real estate. They were modest real estate investors. So I had exposure to that growing up. When we moved to Dallas, I also was in the antique and art business. I was third generation in that business. That we relocated to Dallas in 1979. We bought a property for our antique and art business in Dallas. For those of you who know, Dallas is on Maple Avenue, the Hotel Saint Germain across from the Crescent. The crescent was not there then. And in 1979, that was when interest rates started going up, and it was a difficult time to be in a luxury business. And the antique business never really did that great in Dallas. But that piece of real estate that we bought turned out to be a fantastic investment once they announced the Crescent right across the street from us. So I decided at that point to leave the antique and art world. From a business point of view, I still enjoy antiques and art, and started my real estate career at that.
What did your family ultimately do with that piece of property there? You'd said that it became quite valuable for you and turned out well after the development of the Crescent Hotel. What happened with that piece of real estate?
We sold it in 1983, and I took my share, which for me was a young man in his 20s, and used it to launch my real estate career.
Okay. And then the first foray was that, I made a mention of the, during the intro there about you being one of the pioneers of the flex space world back in the 90s. Was that one of the first forays?
It was not right away, but one of the first deals that I bought was a warehouse, actually a cold storage warehouse. It turned out to be. We at that time I was just doing a bunch of small deals, some apartments, shopping centers, warehouses, land, all in Dallas at that moment. Later on, we started moving into to additional markets, and we found this kind of space in the light industrial flex space, all the different words that we use for industrial these days. But also, as you mentioned, we have investors. Now we have investors from 11 different countries, but I had a kind of a natural constituency with relationships in Canada, and I had met a number of people who in Montreal, some who I got to know just through various friends and family, and others who reached out to me after the savings and loan crisis in the U.S. in the 80s. People in Canada, around the world, I guess, saw what was contacting me. Some actually real estate people in Montreal, some who I did not know and have become lifelong friends, and some who became my mentors. And they enlightened me to the attributes of warehouses, even though I had done some of them, but they, really, we got into it in a much deeper way and bought millions of square feet from the RTC at various failed institutions. Considered going public, but decided not to do that. But really went to school in that time of buying those kind of properties, not exclusively. We're still buying other stuff as well, office buildings and multifamily and retail centers. But we did do a lot of industrial, and we kept on doing a lot of industrial, and we are still today, as you said.
Where is the proportionate share of your time spent? Is it in the multifamily or the industrial side? Is it fairly split down the middle?
We're about 2/3 of our portfolio is industrial, and about 25% multifamily.
Okay, fantastic.
And about 10% office.
Got it. I appreciate that. And so let's talk about 2021 to 2022, right? I mean, some major changes in the debt markets have just occurred. As we record this on April 5th, you probably aren't going to be listening to it on April 5th, but as we record on April 5th, just within a few weeks' time, things have been shaken up quite a bit. I think you use the terminology as choppy, right? And you've obviously been through a few different recessionary periods of time, each one of them being different than the next. What is your, not necessarily forecast? I hate the whole crystal ball thing, and what ultimately do you think is going to happen? Obviously, there's discussions around that, I'm sure, inside your company. But I guess more specifically, are there any changes that your group is making at present time? Maybe recapitalizing assets that you intend to hold for a long time, or looking to exit out of a few that maybe you hadn't anticipated selling off, but now it seems though the time might be right, and it only might get worse as the the months and years go on. And so, what changes are you guys taking in your business to prepare for any potential recessionary periods?
So the first thing I would say is what we have done leading up to this, because We all saw this coming. We didn't see the war, of course, but we all saw that interest rates were going to be going up. And I think it's the combination of those two things right now that are causing dissonance in the marketplace. We've just been more careful than we always are in the last 6 months, 2 years, whatever time frame. I've been saying for years that I've never seen the market this buoyant and this much liquidity. But I will add to that the other side of that statement, that I've also never seen rent growth like this. So there has been a justification from my point of view to pay certain prices. Cap rates have dropped for sure. But, as I said, when the rent growth is as high as it is and interest rates have been as low as they are, there's other things beside cap rate that you need to look at. But yeah, taking us to where we are today, we're just being more careful. We're definitely working on much more on fixed debt opportunities on our debt structures. We always hedge our debt. In other words, we'll cap our exposure. If we're doing a bridge loan with floating rate debt, we'll make sure that we buy a hedge or a cap or whatever is more appropriate for the loan that we're doing to make sure that we've contained our interest rate exposure. So we'll continue to do that. Probably the most important thing is on the leverage side. We do not employ mezzanine or preferred equity in our debt structures. That's just kind of something that I've been a strong proponent of doing for many years. It can work great when everything works right, but when things don't go your way, as potentially they are now, it could be quite hazardous and dangerous. And I think one of the brokers was telling somebody in our shop just this week that they think there's going to be a lot of apartment deals coming to market for those folks that have used preferred equity and mezzanine, because those deals were underwriting. They were a high wire act. Everything was pushed to perfection, and that's just not a good way to live in the real estate business. I mean, leverage works in your favor, but then there's a tipping point where it starts to turn against you. So I think that's the big one for us. That as long as you can go to sleep at night and know what you're doing on with your property, that you can pay your debt service and meet your expenses and deal with other things too. We're dealing with headwinds on the tax side, real estate taxes in Texas, where we've just got a bunch of our numbers and in Houston the other day, and those tax increases are going to be very, very substantial. So that's another thing to look out for. I mean, Texas, and I love Texas, right? But I'm just saying it the way it is, that people talk about that there's no state income tax, which is true, but the money's got to come from somewhere. And so what happens in Texas is that they raise those real estate taxes, and that's what's happening at the moment.
How successful has your group been at disputing those reassessments historically?
It's a good question. Pretty successful. I wouldn't say we always get what we want, but we put forth numbers that we think are supportable, right? By the comps, by the performance of the property, by what's going on at the property level. So we have dedicated people in our house that's all they do, and teams of consultants in all the markets that we work in. Though Texas is the most challenging for the reason that I said. And when we have to, we sue the government entities, and I would say most of the time we end up making settlements that we can live with. But it's challenging for sure. What's challenging also is in the interim period between the time that they come out with the numbers and the time that you might make a settlement could be a couple of years, and you have to pay the higher rate of taxes during that period. So it's often painful.
Yeah. Switching gears here for a second, I read a couple of recent articles about, and it's not a news sector in the industrial world, but I guess it's the first time I had actually ever heard the acronym, the iOS side of the sector of the business, industrial outdoor storage. Is your group? I'm assuming you're familiar with that part of the business. Is that a place where you guys are at present time? Do you have any iOS assets?
Not formally. We bid on a truck terminal portfolio a few months back, and we've certainly had properties where storage was a very important feature. We have some today. It's an important part of the business that's going to continue to be important attributes of certain properties, especially the properties that are a bit more inner city. That land is very scarce, and I think what we're continuing to see is that all new developments in the last few years, land's gotten more expensive, of course, and the requirements for storage and velocity of turning goods as a result of that are becoming more and more. And in those newer properties, they can't afford to give a lot of land for storage. So the older properties that were built at a time where it was a bit more affordable to do that are becoming sought after and attractive for that reason.
Last question here, Cliff, and I'm going to let you get back to your day. It's a question. I kind of have fun with this last question here. It's a good way to exit out the show. And you've been at this now 3+ decades. Not one deal is the same as the next one. They all have their challenges. They all have their just roadblocks and just amount of stress associated with each one. What one deal? I'm sure you've had many that fit in this category, but if you can think of a deal that was more challenging than most, kept you up the most at night, gave you the most gray hair, however you want to define it, but it was just one that sticks in your mind and probably will never leave. What was the deal? What was the challenge associated with it? And then ultimately, what was the outcome?
Oh, you're right that there's more than one. I'm flashing through. I guess for me, it was the Bronco Bowl. We used to own the Bronco Bowl in Dallas, which is a unique property. It was a 140,000 square foot entertainment center. Originally, it had 72 bowling lanes, and then this big theater at the back, a 3,300 seat theater. And you could ask, what were you doing owning that? It doesn't sound like warehouses or apartments.
Right.
And I would answer your question and say, you're right. It was definitely something different. We bought that property out of bankruptcy, and it was supposed to be what it was when we converted it to a bunch of leases. We had somebody leasing the theater and somebody leasing the bowling, and I didn't say there were a bunch of other pieces in there. There was banquet halls and laser tag and all kinds of stuff. We had tenants for all those things. All the tenants defaulted, and we ended up having to step into management and of that facility for 8 years.
Wow.
I had a liquor license in my name. I mean, there was a lot of fun too. We had every big act you could imagine. Bruce Springsteen, Bob Dylan, everybody played there. That was great, but running it was difficult. So the end of that story is that eventually it was just not, it outlived its day, and we got approached by Home Depot it was a valuable site in a good location in Dallas, and we actually tore down the Bronco Bowl, sad as it was for me and still for others. And it became a shopping center that you'd see in, various locations all throughout the country. A Home Depot anchored by a Walgreens and a Chase Bank. And we had another site where we sold off to somebody who built a retirement center. And so it ended fine, but it was, there was a few years in there where it was, you say keep you up at night. I was up at night, not because I was sleeping, but because it was, watching people count the cash after the night was
Oh my
finished.
gosh. So it sounds like that was probably one of the more interesting covered land plays.
You're right. Interesting,
And
challenging, and
my guess is that probably either you or some of your associates or partners probably have some relics, in their homes or in their offices before you guys tore that down. I guess there's probably some decent, cool artifacts to keep. It sounds, maybe not, but
yeah, not too much. But there's still every once in a while I'll get an email from somebody, or even a mention in the Dallas paper about it. It was an iconic place, and the sound was fantastic, and relatively small room. So
yeah, well, that's fantastic. I appreciate you sharing that, Cliff, and appreciate you coming on the show. It's been a lot of fun having you. I know you're out on the road, so I'm gonna let you get back to your day. Wishing you the best on your travels, and hope you're out there uncovering some great opportunities. And again, just appreciate you coming on and spending time with us.
My pleasure. Thank you so much for having me.
Alrighty, guys, that's all we have for this week's show. So until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. Take care now.